All right, everybody. Good morning. Welcome back to another live stream. Just posting a bit of an update here to members on this NAS 100 position that I'm in. Bit of a frustrating thing happens sometimes overnight because the NAS 100 is a CFD, sort of tracks the futures market, and I trade ETFs. Sometimes there is a bit of a discrepancy in what happens with my positioning. So you can see I am still in this NAS 100 position through the QQQ. So I'm in the NASDAQ triple Q's position, but my trailing stop was tagged on my NAS 100 position. So I'm trying to figure out what I want to do with that. It's a really frustrating thing when this happens, but it does happen periodically where one gets stopped and the other doesn't. And because I use NAS 100 to track my ideas, can be a little frustrating. Anyways, good morning. Welcome back. We are here for the NFP release, which comes out here in just about 15 minutes. Could be a pretty market moving event. This is the first major jobs report that we're going to be getting that is recent information. We, of course, are getting November's data, or is that right? Am I blanking on that? I think it's November's data. Yes, we're getting November's data today. So delayed by a few days, but still getting it, which is, we're kind of backlogging everything from the government shutdown period. But it looks like we're going to get the November's numbers here in December, which will give us a little bit of an outlook as to what the U.S. jobs market's looking like. We are very close, guys. If you are an Edgefinder super fan, we're really close to adding some additional jobs data to the Edgefinder scoring matrix. This stuff takes us a lot of time to build. There's a lot of, calculations and checking and cross-checking and triple-checking our work to make sure that the scoring makes sense. But we have ADP numbers, JOLTS job openings, and unemployment claims soon to be implemented into the scoring matrix that is top setups within Edgefinder. I'm really excited for it. I think it's going to continue to improve the algorithm further to incorporate more key economic metrics about the U.S. jobs market. So we'll keep an eye on it. Going into the jobs report, I have my eye on a couple different charts. Of course, the S&P 500 is resting here at a pretty critical spot, this 6,800 level. It's a big psychological round number, and it is also about 1 to 1.5% off the all-time highs. Let's just see from the peak. Okay, yeah, about 2%, right? 1.5 to 2% range below the all-time highs. That's where we're sitting. So it's not out of the question that with with the jobs number that the market likes, you could get that breakaway move back towards the all-time highs. But I think that you're going to need something special to get us back to fresh all-time highs. That being said, if the jobs number is really bad or really good, I know that could be a little confusing, but I think if you have really strong or really weak jobs numbers today, that could be a little bit threatening to the stock market. Now, I think most people can understand, well, really bad jobs make sense why that would be scary for the stock market, because if people are unemployed or people are not getting hired, that threatens obviously the state of the economy, and the state of corporate earnings could take a hit. I think that makes sense to people. But why? This is a question for you guys in the audience to think through here. If you are a fundamentalist or a macro trader, you're trying to figure this stuff out. Why would really strong jobs numbers actually be considered negative by the stock market? In my opinion, I think if you had a very, very strong jobs market statistic, I think the U.S. stock market would actually sell off today. Kind of a weird concept, but let's just say we're expecting, by the way, just 51,000 jobs. That's a very, very soft print. But let's say that we come up with 150K, right? Let's just say that we get a blockbuster jobs number today and we triple the expectation. I think that could actually move the stock market to move lower. Why would that cause that? Alan's got it. It would allow the Fed room to hold interest rates steady. And it would probably sway dramatically things like the 10-year yield. 10-year yield would dramatically spike higher in that case, right? Which would be worrisome for the stock market, because there's certain, and if that happens, by the way, let me tell you something. If you get a really strong jobs print, this is where knowing your fundamentals can be big. If you get a really strong jobs print, I don't see that as negative for the stock market longer term. I think good jobs are good jobs. But do you know what it would probably mean? It would mean the inverse rotation trade. So right now we have a lot of other companies starting to try and take part in the rally. Like if you take a look at RSP, right? This is the equal weight ETF. This thing actually looks pretty decent. Like we actually have some strength here in the average stock. Take a look at this. RSPD, really interesting. This is equal weight consumer discretionary stocks. They're actually making a move higher here. They've been in sort of a slump here recently. And all of a sudden, we've had this really strong rebound from consumer-facing stocks in an equal weighted basis, which means out of the S&P 500 different companies, or it's not 500, but out of the S&P 500, this is a equal weighted consumer-facing stock collection. So it's not like Amazon's just dominating this, which, by the way, wouldn't even help. Amazon's been down, but it's showing you've got some nice, participation from the market here recently. And actually, tech seems to be underperforming recently, right? Here's tech making a move lower, but then you have the RSP, holding steady up here. So anyways, what I think would happen is that if you get really strong jobs numbers, people probably just go right back to the Magnificent Seven. Why? Because these companies don't really need low borrowing rates from the Fed to continue to churn in profits. Okay. Companies that are smaller that need to borrow more money, take, for example, the IWM, right? Here's the Russell 2000 index or the ETF for it. This collection of stocks, these are smaller companies that require more, they require more, of a sweet spot environment. They need a good economy and they need low borrowing costs. That's where these stocks really fly. Typically, when we come out of a recession for the first time, Russell 2000, that's like the time to be long the Russell, right? Is when you have government stimulus, the economy starts picking up again, boom, there goes the Russell. That being said, we'll see, because if you're looking at, the S&P 500 here today, the equal weighted S&P 500 is still very comprised of tech stocks. So you've had this sort of consolidation in the last few months. We haven't really gone anywhere. So we'll see. But again, the jobs number today is really big because, and let's just pull that back up again. So we're expecting just 51,000 jobs added to the U.S. economy. What do you think the NFP's effect on DXY? So pretty straightforward. And in terms of jobs numbers, it's very straightforward for the US dollar. If you get a big beat, it's strong for the dollar. If you get a big miss, it's bearish for the dollar. If you get something near it, the dollar just chops around. That's pretty much it. Currencies with this data are a little bit more straightforward. Stocks, a little bit more tricky. But it's not even just NFP. I mean, this is actually a monster morning for data. We're getting NFP. We're getting retail sales, which will give us an insight into the consumer spending behavior, unemployment rate, average hourly earnings, core retail sales. I mean, this is a monster morning here in terms of data. And we're going to get some PMI data an hour and 15 minutes later. So, yeah, should be really interesting to see what this brings us this morning. So if, like I said, so if you get retail sales, let's say retail sales are weak and the jobs number is weak, the dollar would likely have a rough day. What if the NFP had a really strong number, but the retail sales had a miss? The dollar would probably focus more on this. The jobs numbers probably take precedence over retail sales, unless retail sales were just massively above or below expectations. But most likely, this is what's going to move. This and this are what is going to move the market this morning. Unemployment rate, if that ticks higher or lower, and the jobs print, if that ticks higher or lower. So those are the numbers we want to be watching. Let's just take a quick look at the DXY ahead of the print. The dollar index has been trending lower here, guys. So this is interesting. Check this out. What was a major level of support actually seems to be breaking now. This is big. The dollar is really trending lower. Is gold moving lower, moving higher today? I would suspect it is, but it's not. Take a look at that. Well, I guess it's just holding on to its gains. It's been doing really well here recently. But dollar, look at this. You are breaking through a critical area of support. So we'll see. I mean, if you get a weak jobs print today, very possible we could see the swoop down to this 97.60, which I would say is our next area of obvious support for the dollar index. But this thing seems to be straight up in a downtrend now. You got the double top, break of structure, right? We've gone from higher lows and higher highs to lower highs and lower lows. So dollar index looks like it has some weakness to it for now. Again, gold pressing up against those all-time highs, getting close. If you get a really poor jobs number today, the dollar likely moves lower and gold probably breaks out. However, if you get that very strong jobs print, it could set sort of a short-term top for gold. So that's why this data, it matters so much. It has the potential to reverse trends on a dime. It's very, very strong. Why does it matter so much to markets? Well, because it determines or helps to determine what the Federal Reserve wants to do next. If the jobs numbers are coming in really strong, they feel less pressured to help the economy through rate cuts and through their QE stuff, right? So if they have this program of buying back their own bonds, they can slow their pace or increase their pace based on what they want to do. They can also lower or raise interest rates. So they have these like tools, these financial engineering tools that they use to try and regulate the economy. It's a very interesting thing that they do. But regardless of your thoughts on it, it moves the markets massively because they're the big printer in the room. They can print money or stop the printing. And that's why we care about it, because it moves the market. Take a look at this. Bitcoin still range bound here at the bottom. I have not a lot of interest in this one. And by the way, guys, once the jobs data drops, that's where things get a little bit more interesting, because I don't take like trades minute to minute right before the NFP release. But afterwards, if I can find the right setup with the new jobs data information, that can actually set up a really strong catalyst for some really strong trade ideas. So if you're not subscribed, make sure to subscribe, do all the YouTube things, and don't go anywhere, because after the print, things usually get more interesting in terms of actually having a bias. It's going to impact on our scoring matrix here for the Edge Finder, employment change and unemployment rate. These things will update with the new NFP data today, which could drastically change scores. So we could have some changing of the guard here on what's looking strong, what's looking weak. If you get an outright bearish, I'll say this, I'm more worried if you have a terrible jobs print for the stock market and Bitcoin and all the risk assets, than if you were to have a really strong jobs print that deters the Fed from cutting interest rates. I'm definitely more fearful, more worried about a terrible jobs market number. So we'll see. We have about 1 minute, 15 seconds to go. Please be careful. Don't use a bunch of leverage on this stuff. You can lose a ton of money trading news because it can move very quickly, and the swaps or the spreads on your brokerage can mean a ton of slippage in your account. So please be careful. A lot of people lose a lot of money on these days. So don't be one of them. Trade smart, trade small. Don't trade big size. That's the quickest way to mess up in markets. Almost always a problem. If somebody has a big, bad story to tell about trading, almost always the problem is their position size was way too big. Okay, so let's see. We got about 40 seconds to go. I'm going to switch over to our all markets view. What this will allow us to do is see a bunch of charts at once. So we have S&P 500, US 30, NASDAQ, Bitcoin, gold, the dollar, silver, and crude oil here, or West Texas oil here on the bottom right. So we've got all of our charts here. We've got how much time? We got about 15 seconds here to go before we get the print. We'll see what we get. Expecting around 50,000 jobs added to the U.S. economy, and for unemployment rate to remain at 4.5%. Let's see what the numbers are. We'll just the price reaction here first. Initial reaction is S&P 500 pushing a little bit to the upside. Gold pushing a little higher. Dollar is lower. Okay. Dollar is lower. Gold higher. not a huge reaction so far, and a little bit of an intra candle reversal here on the indices. Dollar index bouncing a little bit. Gold is moving higher here. That tells me maybe it was soft. Soft jobs? Nope. About in line with expectations. Okay. But nope, it was soft. Here it is. So in line with expectations, or very close to it on the jobs print, but tick up in unemployment to 4.6%. So unemployment on the rise. That's 2 times in a row that we've ticked up by 0.1%. So very interesting to see that. 64,000 jobs added to the U.S. economy. That's slightly better than expected. Retail sales were soft. So retail sales came in at 0% month over month compared to 0.1%, although core retail sales were up. So let's call that a wash. Average hourly earnings increased slightly lower, actually lower than expected. And unemployment rate went up. That is showing a little bit of a lackluster jobs print. And you can see not mission critical, because again, let me actually make a case for why this is what the market wanted. So 4.6%, it's weird. Unemployment rate is rising. This is still historically low, but we didn't have, if this was like -20, you'd be looking at a really ugly print today. But you had this number hold up okay. This is a repeat of the last NFP. 4.6% came in slightly higher than expected. So this, you know what this does? This bolsters the idea that we're going to get rate cuts without too much disaster, at least right now. I think that's the way to explain this, and that's why the dollar is lower. That makes good sense. We have gold moving higher, silver moving higher, NAS, S&P, and Dow Jones moving higher. What's up, Chris?
Good morning. How are we doing?
I'm good. How are you doing?
I'm good. I'm well. Yeah, just looking at the news, same thing. I was actually just checking the Fed Watch tool to see if this changes the 2026 outlook at all. Not really. So still looking for a pause. Maybe a higher probability coming in April, June for the first rate cut.
Mm-hmm.
If I'm not mistaken, Hass is no longer the front runner either. That's been switched.
Did it change?
Been switching around. I think it's been switching around. Yeah.
I saw it was like 50-50 yesterday. I don't know.
I thought it was Walsh now. Let me double check.
Yeah, Walsh. Yeah, very, very close. Very interesting. Yeah, we're seeing that. I think either ways, it's going to be someone who is, in line with the dovish behavior or idea. But it's going to be a Kevin. We know that for sure. It's either Kevin Walsh or Kevin.
There we go.
Bassett. Yeah.
I'll take that to the prediction markets. I will go, 10-1 for Kevin.
Yep, exactly.
Yep,
so
no last name.
Yeah. So Chris, I think the best way to explain this, at least from what I'm telling, is that this is. It's weird how this works, but the market wants not too hot, not too cold. They want, and this is not critical. It's weird that the market is sort of like, hey, yes, we ticked up a little bit in unemployment rate, but I think where they're okay with it is like, okay, well, we didn't lose a bunch of jobs on an employment change basis. So it's not the perfect number, but I think the market's tolerating it for now.
For now, I mean, just look at our S&P pattern. I mean, are we looking at sideways range, double top maybe? I don't know, man. There's a lot of support underneath, but those 2 massive sell-off days, de-risking and watching the VIX rip up to the high 20s and then fade all the way back down. We had the VIX in the 14s before last week, and we had like a single day spike up in the 17s again. Yeah, today it's like as you were talking through the news, the futures market jumped from 0.7 positive to now 0.96. Mm-hmm. So we're going to look at like a pretty big open this morning that's going to be much higher. We're just kind of stuck between this like 6,900, 6,800 area right now for the S&P.
Yeah, really an interesting move overnight too. You had, I'm not even sure what was the headline, but you sort of had a follow through that to the downside to yesterday's intraday reversal. What's volatility looking like, Chris? I mean, in the option, you're the options guy. What's the options world looking like right now?
Nothing shocking. I mean, we had a jump up overnight and it's faded back down. So I mean, 16s. This is kind of a little bit elevated, but I think what we really have to see price action wise is if we're going to get a break above highs, VIX probably goes back to sub 15. If we get a break back down, let's say take out like the start pulling price back into the NVIDIA sell-off candle or the October 10th candle, VIX might spike up into the 20s again. I don't think we're gonna have like a. I mean, this is a major options expiration this week. We have VIX expiration, indexes, stocks, futures all expiring on Friday.
Yep.
So triple witching, quadruple witching, whatever you're going to call it, it's a big one. I think nominal expirations are biggest on record, but it's like that every single month now. I just think there's maybe some vulnerability right after this week, which unfortunately takes us into holiday trading. So I'm not doing a lot of like forced trading at this time. I'm being like really picky on day trades. Picking my levels, doing mostly like high reward, low risk trades, and trying to get a couple like pins through the day. But otherwise, I'm just pruning the portfolio, man. I mean, I've got a lot of expirations this week. I've got trades that I need to be rolling. Here's some of my expirations that I have. So let me go full portfolio. Here we go. So I've got a trade that expires today for full profit on oil futures. I've got Russell futures. That's a hedge. 5,000 that I wasted, but I'm up. Let's go IWM here. I'm still running a campaign trade for IWM that was in Pulver Alerts. This is up, about $18,000. So I've given back 5 on a hedge. It's up 18 plus. I'm still rolling calls, so I'll continue to build it up into more profit. What else is pressing for this week, expiration wise? Bitcoin expires. I've got some puts out there. I also have some collar trades. We'll see if that is good or bad. It's down mostly. Like Bitcoin has been honestly like really crappy. I mean, I had a pretty good chunk of P&L running for the year. I was up, 34%. I still am up into the 30%, but Bitcoin has not been any contributor to that, which has kind of made me mad.
Yeah, it's been just a frustrating trade. I mean, I thought you'd get that end of year kind of bump in Bitcoin, but no, it's been a rough ride for the crypto crowd. Speaking on the Russell, you just mentioned it.
Yep.
So this is the setup for the Russell, I think, in 2026.
Okay.
If you are thinking like the Russell is the centerpiece, I think, right now to the conversation in a way, because you have the bulls who are saying, okay, the market is going to see the Fed continue to cut interest rates into an economy that's already got their stock market near the all-time highs. Growth is still there, corporate earnings still growing, and yet you have the Fed cutting interest rates. The Russell, in theory, if everything else holds up, should be a strong performer. That's the theory. It's like if you have more rate cuts in an economy that is, rebounding or growing, but the problem is not necessarily like you're going to get rate cuts. It's almost that the rate cut part is the easy part. Like, okay, you're probably going to continue to see the Fed ease. The question is, does the Fed continue to ease into an economy that is holding up, or is the economy souring faster to the point that the rate cuts won't be enough? That's the difficulty in this Russell trade, because, take a look at RSP, for example. I've been really impressed by this recently, Chris. You've had equal weight actually doing okay. And it's refreshing to an extent because it's just been tech stock. And now you have, healthcare doing pretty well. You've had some of the participation across the broad ETF is doing okay. Take a look at RSPD. I think this is actually kind of encouraging. This is an equal weighted consumer discretionary ETF that has been down sloping, and then boom, it recently sort of popped higher on the idea that, the Fed's cutting interest rates. And it's not that the 0.25% cut, that's nothing, right? That doesn't do anything. Is the Fed going to do Trump's bidding in the idea of getting, he said yesterday, Chris, he wants the interest rate to get down to 1%. That's a huge difference in terms of borrowing costs for credit cards and for auto loans and all that stuff.
If yields come down.
If yields come down and the economy, if you're chasing a downward economy, that's ugly, right? Rate cuts because we're behind the economy falling apart, that's ugly. But rate cuts into an economy that's holding up okay, that's where you get 1995 to 2000, right? Where you're cutting interest rates into an economy that's holding up. So that's the hard part, right? It's hard to determine where we are in the economic cycle. Are we in a a temporary lull, and then we're going to accelerate again off all the government spending, or is it too little, too late? That's the difficulty.
That's a huge question for 2026. I'd like to think that I think we're in the camp of and again, with a lot of assistance, we're in the camp of we can be resilient. Like maybe not crazy bullish, but we can be resilient. So I'm looking at this like I'm pretty sure we have the mechanisms in place, the levers in place, the tools, programs in place to keep. I mean, look, man, we have not had a real full felt recession in years. And I think that's what we still have now. It's like we have like pockets of the economy, the bottom of the K, if you will, that are feeling the pressure of higher inflation, feeling the recessionary type environments. But it's like it's just not felt all at once.
It's been like the rotating recession.
Yeah, it's like a rotating recession. It's happened since 2022. We've come out of it ahead in certain sectors. We've come out of it. I mean, I just think right now it's like the bottom of the K feels it. I don't know how that changes. I mean, it would be weird to see like if the stock market gives up some of these gains, we could quickly go into like a more felt recession. But I think this market in so many ways can have that manipulation behind it where it's like, man, stock market just doesn't want to go down. And going into 2026, I almost wonder if, since we had like a Liberation Day, drama fest in 2025, if 2026 is going to feel a lot like 2017, which is super low volatility, but yet the market finds a way to just grind, very low percentages, but grinds higher. I mean, I think 2017 year to date was like a 11% year or 12% year. Let me look at to see if I can find a 12-month candle there.
I remember that time being,
but really it was not even a single month was like over 1%. It was just like
there were no pullbacks. I just remember being like, I want to buy some stocks, but I can't.
It was crazy. Let's go 20. There's 19. Yeah, 2017 was a positive year. Year to date, I'm ballparking here, but year to date, is that right? 2017 year to date shows 18, just under 18% or just over 18%, which is a pretty decent year, but it happened with like just around like this, like 0.5 to 1.5% every single month, with, like you said, no pullbacks. It was a really weird year, but midterms might make it a little bit rockier. Dude, I don't know, man. It's such a hard thing to know. I keep staring at this price pattern. We've had, I watch this stuff obviously every single day. Last week, the expected moves inside the S&P, the implied volatility, all these things were not really hitting the proper math levels. Like when I look at the implied volatility in the VIX, I can do a pretty good job of calculating like the highs and lows for the day. You take the market maker move. We have been seeing price go beyond the expected move for the last 4 days in a row, which is very, very, very unusual. So, I mean, it leads me to think like right now, even though this is the last full week of trading, it does lead me to believe that there is a little bit less volume, a little bit less liquidity, and markets are just kind of throwing things around. Like, I mean, to have the futures move 0.7 this morning up to 0.9, back to 0.8, I mean, it still doesn't take us outside of the range. If you look at where we are, like going from yesterday's close 0.8% higher, okay, we're going to be up around 68.70 today. Still, resistance around 69, support around 68. That's a big intraday swing opportunity. I just think it's like until price is going to break above 69 or break back below 68 or 67.70, you're stuck. And I think this is what we're kind of figuring out through the holidays is like, are we going to see a price that gives us some follow through, or are we going to trade a bunch of noise back and forth with gaps? And it's like, there's no real direction. It's just a bunch of chop. I'm kind of looking at that right now until we actually have confirmation above 69 or below 67.70.
Sure. There you go. And if we could just switch over to my screen one more time, just for people who are just tuning in, just going back over the numbers that we got this morning in terms of, we actually had a lot. We had retail sales statistics, which came in slow, which is actually maybe not too surprising. We know, we talk about it all the time, Chris, the consumer, the K-shaped economy, right? You have the haves and the have-nots, people who, have been enjoying the stock market rally, real estate asset prices rising. That's the cohort of the consumer that's doing quite well and supporting a lot of the spend that's going on. Also, corporate earnings have been high, so businesses contribute to the top side. And then the downside is the average person in America, right? And that can't go on forever, right? You either have this thing crumble, or it's one of the two things happen, Chris. Either this ends, the upper end ends, or the bottom end starts to feel better. And I don't know which way it goes. It's really difficult to call that, right? But it's going to happen. These don't go forever. In 1929, this happened for like 5 years. And then this scenario happened where the top end, capitulated. The stock market started dropping, and the people who had money no longer felt like they had money, and it tanked the economy.
Mm-hmm.
Is it going to happen that same way? Or is it going to be in other periods of time where you have the lower end starts to get a bump from, whether it be fiscal spending, borrowing costs, whatever it is, some other way where they catch up? That's the difficulty in determining. Here's a really interesting point. So these numbers are super low. 50,000 jobs added, 60,000 jobs.
Yeah.
I mean, go back over the last 10, 15 years, we've had periods where, post-pandemic, we're hiring like 250, 300, 350,000 jobs, obviously, because that's a rebound period. During the rebound periods, it's going to explode. But then you have these numbers, and it's sort of like the jobs market is just stagnant. It's not, it's not moving. You have layoffs, at least from what we can see, are not dramatic, but at the same time, you just don't have companies hiring. You also have this post-pandemic era where it's like people may have overhired during that period of time and now are letting people, kind of fall off the payroll. So it's an interesting time, and it's hard to read too far into this because these numbers are not huge. They're holding up to expectations, but unemployment rate is still on the rise. So it's tricky, Chris, to really determine which way the economy is. The economy on pause, like it's just cooling, it's slowing before it accelerates again, or is it cooling because it's fully turning to the downside?
I think the other thing that you're never going to get a clear picture of the employment market is we have created a very supportive gig economy where some of that data is not in our employment numbers.
True.
Like if you
freelancers, man,
if you're a 1099, you're driving for Uber, you're doing something where it's like you have a job, it's just not officially being counted here. Survey participation is down to historical lows. So it's in a way, it's like, it's just hard to believe. Like, I know the data is out there. It's just hard to believe. Like, it's like, I think there's a lot of resiliency built in. I think we have an agenda that is like support this economy at all costs. But that comes with like we have seen for these great opportunities in the stock market, that comes with some nasty moves. So could the market break down and hit, a 10, 15, 20% correction? Yes. But then it probably gets backstopped aggressively. It's like, look, Powell, like him or hate him, too little, too late, whatever it is. Look, the Fed is cutting. Powell is kind of ending his little legacy with what he has done is he has allowed the Fed to be way more vocal than ever before. Having multiple dissents in these last couple of meetings, when it's like the pivot from like pausing to cutting, that was all due to like Fed talk. I mean, over the course of that 1 or 2 weeks before we came into the actual Fed rate decision, every Fed speaker was out doing pressers and making headlines. And I don't remember a time where it's like every Fed speaker is now like out and about and talking. So I almost think he's getting the group in the room to like actually talk and debate, and there might be more dissent. I don't think that's to like create a rift in the Fed. I think it's just, I don't know. I guess these are smart people. They're supposed to be smart people. Sure. But it's always been a reactive. It's been a reactive function. So the Fed is trying, but we have fiscal policy that continues to overshadow what the Fed is doing. And look, man, that K shape. If we're going to bring the K shape down, if you're going to take your top of the K and bring that wealth effect down, honestly, Nick, I don't think that helps the bottom at all. I think if we bring this down, we bring this down, and then we have to still recover the same way. It's like, it's not going to be
again, going back to the 1929 example.
Yeah.
Rich people had it bad, but poor people had it absolutely horrendous. Right. So it's like, it's never advantageous to be on the bottom side of the K, unfortunately.
Yeah. I think it's fair to say in the US, like very little is going to be done to help poor. It's like Republicans are socialists for the wealthy. Democrats are socialists for the in need, but either way, it's like we still look at ourselves like we're this bootstrap economy. Like, oh, you can do this and you can climb the socioeconomic ladder. But the reality is, we have way too much riding in the real estate market. We have way too much riding in the stock market. We have way too many households participating in equity exposure. versus the, the T-bill and chill type stuff, which like I'm not a big subscriber of. I don't think that's a good look for any portfolio. I feel like if I wanted, we talked about this a little bit last week, like if I wanted risk-free trades, I've got a 4.5% trade I can go after for the next year and be happy. But it's like, I'm never going to be happy that way. I'd rather have 56, 57% cash, know that I can participate in opportunities, lower cost basis, use options, and figure out how to grind out, anything better than 4%. It's like 4.5. Honestly, between inflation and the rising cost of everything, I don't think people are going to be much happier in their portfolio if you're not making like 6, 7, 8%. 4% is still going to get you to fall behind, in my opinion. That's the bad part.
Right, exactly. I mean, because if inflation ticks up to, let's just assume it gets up to 4, like that, just you bake in a little bit of worry there, and then you have 4% inflation, and so if your portfolio does 8%, you really get 4, and then you have taxes too. So it's tricky.
Yeah. Yep.
What about commodities, Chris? Going off that same line of thinking, if you think there could be a bump in prices, continued fiscal spending, Treasury continues to, or we continue to borrow money at record paces. Is there something to be said about, gold has had a monster couple of years. Like this is an ongoing theme here, and we know how this can end, right? We don't know where the trend ends, but the old expression, right? The trend is your friend until the end. You don't know where it ends, but until it ends, right? Gold got nasty in 2012, 2013, where it pretty much went nowhere you had a really suspended period of time.
It's a decade, man.
Yeah. So it's like, it was a wonderful trending asset for a while and then completely fell off. My perception on it is you don't know where it's going to stop. For now, the trend is your friend.
Yeah.
Until the end, right? That's the expression. So what's your thoughts on gold, silver, or other commodities, just in general, commodities for 2026? Do you feel optimistic about them? Are you cautious?
I'm optimistic as far as an allocation. I'm just setting very little expectations for like expecting another 50 to 100% gain. It's like if it happens, then we're just going to go into a straight up precious metals bubble, because I don't think we can keep sustaining levels like that. So if anything, this is all exciting. This maybe gets the retail crowd super excited. My like contrarian sentiment play is when people are having like gold parties and silver parties and they're rushing to pawn shops to sell their gold or silver, or wanting to buy more gold. It's like, it's just, if it's that popular where everyone is just scrambling to transact in gold, silver for some type of profit, some type of hustle, it just doesn't end well typically.
Gamified.
So yeah, I mean, I'm looking at like, okay, man, I like having 5 or 10% gold, silver. I'd rather have that versus bond exposure. But it also might be something where I'm going to sit on it for the next 3 to 5 years. Like, look, this position I took this year off the table was a 3-year position in gold and silver. So I have the patience.
Wow.
I think I've got the patience to like sit in there for another 3 to 5 years and hope that I'm getting a good cost basis, and ultimately all-time highs aren't done. It's like, let's make some fresh all-time highs, but maybe a chop fest for the next 6 to 12 months, if not more, to kind of cool this market down would be fine. If we run higher, I mean, if silver has another 100% plus year, great. I mean, let's make some profit along the way, but obviously getting like more and more skeptical and cautious as something like that were to take place. But probably sideways. I think that the retail crowd would probably be very frothy at these tops, hoping for more, and they're easily left as a bag holders when something doesn't move.
Yeah, no, it's I think that the easy money, quote unquote, and I know this is obviously hindsight, but not really for us, Chris. I mean, people who have been watching know you and I have been fans of the metals for a couple of years now. So I'm not speaking with necessary hindsight, but I do think that the quote unquote, I hate this expression, but it works in this case, the easier money in this trade is behind us, because the Fed was cutting interest rates, global central banks are cutting interest rates. That story has played out for a little while. The uncertainties around the election, the uncertainties around what's happening in Russia, what's happening in the Middle East, some of those themes, and national debt's on the rise. I mean, I still think that's a bullish reason for gold to this day, but that rate cut tailwind, which on a secular, I mean, this is what global interest rates coming down. That's what that looks like. Okay. Gold, fiat currency, losing value quickly means precious metals kind of hold their value, meaning that they go up. So I think that trade is not as obvious anymore. Like, for example, the ECB, who was cutting aggressively the last few years, they look like they're probably done, right? They look like they're, for now, unless you get some sort of global recession, they've indicated that they think that they're at the tail end of their cutting cycle. The central bank, every cut for the U.S. is like a battlefield to try and get a rate cut. So I think that the easy money, quote unquote, in gold is likely behind us in terms of the short term. I'm still a believer. I like, for the long term, I'm a bull on precious metals, and I have been for years and years and years, because I think national debt's rising is enough by itself to keep an allocation of portfolio, as you mentioned. I'm the same way on that. I think that Ray Dalio is a big advocate for, I think, 5 or 10%, something like that, in a portfolio, and I generally agree with that, though I think it wouldn't be significantly more than that for me at this time. I think, 5-10% is probably, but I was listening to, there's this one guy, Jeffrey Gunlock. I think he's
what's his, I know who you're talking about. The bond looking fella. Yeah. Bond guy, but he's been talking a lot about, US rotation going into, the more beat up sectors, the more value driven sectors, and also non-US. He's a big believer, like the next 10 years that the world's going to outperform the US.
And, also he's a big advocate for gold. I listened to him. He's like, I've been on the sidelines for gold for a while, but he was like advocating for a bigger allocation to gold. And I thought that was really interesting. I mean, clearly, and that was months ago, so he's been right. So
was he actually in gold, or was he just participating now because it looks good?
I'm not sure. I was only listening to an interview with him, so this was. But anyways,
on your point on gold, though, I would say the gold, I mean, prices will tell us a lot of things too. If gold and silver continue to run, that is kind of the market's way of telling us, like, look, this fiat system is on borrowed time, and this debt bubble is on borrowed time, and it's like, what's the store of value in some type of gold standard? Look, we don't know what's going to happen. Also, like with the U.S. rolling out these stable coins to kind of be in this like synthetic force purchase for like, greasing the wheels of like the debt market. Gold and silver, just they kind of exist on their own. Silver is interesting because it was always seen as just like more of the poor man's gold and the industrial side of silver, which in the AI build out is really important. But now it's also being used and touted as a tactical and strategic metal. And so I'm kind of a fan of silver having more upside than gold, just because there's a use case for it versus just a value case. And because it's cheap enough, I think that it's going to become more and more scarce as like maybe the silver miners and the projects start to ramp up. And I don't know. It's like, I think price will tell us ultimately what to do. Either things go sideways and all of this year's gains are like being chased to the top, and it's a volatile future. It's like, expect 40+% pullbacks, expect 50+% pullbacks. That's okay. That's actually pretty normal. It's not fun for anybody that's like wanting easy money, because that's the least easy when it's like, I'm buying something and it's down 50%. Now I have to wait. It's got to go up 100% to get back to break even. So be patient, and allocation, I think, is for me, it's like to get back to another like 10% gold or 10% silver combination, or maybe, between the two, maybe 10 or 15%. It's going to take months and months and months of like buying dips or looking at levels to kind of scale into, versus like, well, I'll just take my stake right now and then, trade some options around it. I'm not ready to establish a full core position again.
Sure.
Not yet.
Let's
talk oil for a second. You want to talk oil real quick?
I was just going there. You beat me to it.
What's the question? I'm really surprised it's down to these levels. I'm actually glad I have a futures expiration today. It's not in a profit trap. I had futures all the way down to $50, but my chart really quickly here, high, low. This is the high, low. This is pretty rough, but high, low, lower, high, lower, low. I mean, we don't want to talk about better inflation. If oil prices drop, that does happen. My concern is that we start seeing flare-ups in like war type conflicts. If we get prices too low, if we're like sub 40 oil, that's great for energy costs. It's great for inflation. Not that it's necessarily going to translate to consumers. It might translate at the pump a little bit. But we also are maybe offsetting oil prices with like rising electricity costs here in the US.
Well, and Chris, to add to that, if you get oil making that move, if you had a move down to the low 40s, I think we no longer care about inflation. I think we care about recession. Because if you have dramatic drop off in oil prices from here, great, inflation's dead, but so is the economy. If
This
there's no
is 2022. Like we know what happened in the stock market in 2022. So yeah, if we have that type of push lower, and again, like if it's a slow grind like this, like maybe it's not as dramatic, but we rarely see oil when something bad is happening or something quick is happening. It usually has some big consequences for the economy.
Yeah. You want oil prices muted and not moving a whole lot.
Yep.
If they are spiking either direction, that's usually a worrisome thing. So
yeah,
there's
still a chance here. There's still a chance that this level holds. If it does, we'll see. But I mean, every high has been met with fierce resistance, and we are just making lower highs have been since 2023.
Yeah.
So it's tough to argue a bull case for oil.
Yeah, it's been every little rally has been sold into. So, and gold or oil typically it makes these kinds of follow through up moves when you have geopolitical conflict, but that seems to, at least for now, be muted. Things can change on a dime, though. We know how that can go. Chris, we're out of time. We got to throw over. I know you got another show, and we've got our next guest ready to join the stream. So thanks very much for joining me on today's NFP Day.
All right, I'll see you guys soon. Thanks, Dick.
Last thing here before I switch over to Marco is, of course, guys, if you are not already using Edgefinder, we've got our holiday discounts going on right now. Edgefinder currently is 45% off. We are also offering to do payment plans if that's easier for you. We've had some people requesting to do that instead. So if that's something you're interested in, scan the QR code. Well, actually, it's not on the screen right now, but easier, just click the link in the chat. There it is, or scan the QR code above my head. Either ways, don't miss our discounts. We've got our biggest holiday discount of the year going on right now. Get yourself a copy of Edgefinder. Or, by the way, if you want access to trade alerts from Chris Pulver, who was just on, and myself, you can join our VIP room. Just message in, let us know what you're looking for, and we'll get you set up with that. Thanks, guys, for tuning in. Up next, we have Marco's Trading Journey, taking a look at some more charts. Stay tuned. Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90%, and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to my segment of the live stream. I hope everyone is doing well. So this is my first live stream of this week, and we are approaching the year's end. It is now December 16th. Markets are sort of winding down a bit. Usually at the end of the year, you see a bit of a slowdown, a bit less activity, because the big whales, the big hedge funds, portfolio managers, pension fund managers, bank traders, they go on vacation, basically. So they have holidays as the rest of us. The volatility dies down, the liquidity dies down around Christmas, I would say. So expect that to happen. I'm currently flat. I don't have any big positions in the market. I do have a small position, which wasn't a signal in the A1 Discord because it's more of a tester position. I have a small sell setup on the euro against the Swedish krona, if that's the pronunciation, because there's a big seasonality pattern where the Swedish krona gains a lot of value, I believe. Yeah, so gains a lot of value after the 15th of December. But again, this is just an experimental position with very small size. For my big positions and for my signals in the A1 Discord, I currently don't have any trades open. As far as the stock market goes, this is something I want to look at for the beginning of the stream. So as far as the S&P and the NASDAQ go, NASDAQ is my main focus. I'm looking for positions on the NASDAQ. Again, the AI story has the biggest impact on the NASDAQ. NASDAQ has the most volatility, the most movement. So it is of a lot of interest to my personal trading. We are producing some red days. Last week on Friday, we had a big red candle. Looks like there's some follow through during this week. That is interesting to see because the Santa rally should be in play. If you're not familiar with the Santa rally, you can take a look on the Edge Finder seasonality. Basically, November and December usually tend to be very bullish. Right, very bullish. That is the Santa rally. There's also a bit of a rotation from technology stocks into energy, healthcare, and other sectors. So that's also in play, and you can see that because the S&P is not really so bearish. So the S&P is still hovering around the all-time highs or just below all-time highs, while the NASDAQ has pulled back more. There's a clear difference. So there is a clear rotation. If you look at some AI stocks such as Oracle, they look very bearish. If you look at NVIDIA, they look kind of flat overall. I mean, the price has been the same from the 31st of July. There hasn't been any massive movement. Tesla, a meme stock. Let's take a look. Tesla actually is approaching, is that the all-time high? I think it should be. Yeah, it should be the all-time high. So Tesla is actually bullish. Okay, interesting. But I'm personally not super interested to buy the NASDAQ here. I think I'm going to wait for January. I'm going to wait for a bit more clarity. Also, we do have NFP this week. So we do have non-farm payrolls. Let's just see that. Oh, crap. Sorry. So we had NFP. Okay, I'm a bit late to the party, but these may have been older numbers, so this may have been some delayed data. I'm gonna take a look at that a bit later. Yeah, so we just printed the NFP. Anyway, for the NASDAQ, just wanted to give you sort of my whole story, my whole opinion. For the NASDAQ, I'm being a bit patient. I think there's a clear rotation out of technology stocks, out of artificial intelligence into other sectors. The AI story is getting a bit of trouble, catching a bit of smoke, you can say. So I'm not going to be jumping into longs before the year's end. Now, let me take a look at the NFP because I totally missed that it was printing today at 14:30 my time. So let's see. It was more bullish than expected. The unemployment came up. Okay, so kind of mixed. Kind of a mixed result, I would say. A little bit mixed. Yeah. Now, what you have to note is with this artificial intelligence and with the whole AI story, it is expected for productivity to increase because, of course, AI is much faster, much more efficient than humans. But the unemployment rate goes up as well because all of those entry-level jobs, people that can be replaced with AI will eventually become replaced with AI, like the I don't know, the clerks, the analysts, like just collecting data online. That can be done much more efficiently by artificial intelligence. You no longer need, for example, if you're working at a bank, even an investment bank, you no longer need an intern to basically research stuff about a specific investment. You can use ChatGPT, and ChatGPT will bring you everything that you need for further analysis, all of the numbers, all of the data, all of the statistics, and it can bring it in like, I don't know, a minute, 2 minutes, if you have the right prompt. So productivity should go up, while the unemployment rate should go up as well, or the general employment should go down. That's kind of the sad reality of things. So also we had the ADP, which is not something I closely watch, but what we do have upcoming as far as the currency world goes is the Bank of England monetary policy summary official bank rate, and we have the ECB main refinancing rate, okay, right there. And in my opinion, the most important number this week, maybe even more important than actual NFP, that's going to be the BOJ. BOJ policy rate, policy statement, press conference. Now, a rate hike is expected. So I do have USD yen on the watch list. Let's talk about this. I think there is possibly a trading edge to be exploited with the BOJ. So a hike is planned. Okay, so they're planning to hike interest rates. But you know what they did in December 2024? Look at this. So if you go to the replay function, you go to December 18, 2024. And we click replay. And we go to the 1 hour chart. Look at this. So they were actually planning to hike rates in December. The BOJ was getting very hawkish, right? People were expecting them to hike interest rates. And then they came out with no hike. They kept rates the same. And then they actually hiked in January. So they had sort of a delayed interest rate hike. They kind of fooled the markets. UJ exploded higher on this news. You can see, I mean, from the release, let's see, from the release right there, UJ went up, you can say 1.5%, 234 pips. Now that's a good opportunity to take a trade. So I would not be surprised if a similar thing happens this Thursday or on this BOJ event. Again, BOJ is hawkish. They are signaling a rate hike. You have Governor Ueda, or just the BOJ in general. If you look at, for example, Financial Juice, right here, breaking news, Financial Juice, you have them mentioning possible rate hikes. Just a second. Okay. So, yeah, what I want to say, I think the same thing can happen. A rate hike is expected, but the BOJ may actually pause this time and they may actually hike in January. Now, why do they do this? Why do they act so unpredictable? Well, because they want to avoid making or influencing the markets. They want to avoid massive volatility in the markets. So they kind of do these tricks. Like BOJ is the only central bank where if you go to the Forex Factory calendar, their exact time of meeting is tentative. So they don't publish the exact time of when they will release the new rate. Only central bank that does this. So the BOJ, very strange, very unpredictable. They like to trick the markets. They like to do some not shady stuff in the background, but kind of weird stuff in the background. And they're pretty tough to read. If this happens again, if the scenario from December 24 happens again, UJ could go flying. So UJ could go up on this news. I don't have a trade in just yet. I'm possibly considering taking a buy setup just before the event. And if you do some backtesting, if you do some research, you would notice that most of the time, the BOJ happens at around 10 p.m. New York time. Okay, this is the time when BOJ usually happens. So Thursday, you can expect it at around 10 p.m. New York time. For me, it's Friday, but for Americans and New York, it's basically still gonna be Thursday, I believe. And yeah, so I'm looking to take a stab long before the event, counting on that the BOJ will again skip a hike on this meeting and actually hike in January. I think that's a pretty interesting phenomenon. I do want to mention the sponsor of today's video, which is going to be DNA Funded. So if you're looking to get funded, if you're looking to expand your trading capital, again, lack of trading capital is one of the biggest reasons why retail traders never succeed. So they just don't have enough capital. DNA Funded, we have a 25% off with A1 Live. So if you use the code A1 Live, you get 25% off any DNA funded challenge. Now, this is my personal 50K two-phase fund challenge. I'm trading this challenge purely using signals from ChatGPT. Currently, I'm down $2,000, unfortunately, so nowhere close to a payout. I have 2 trades open. One is a sell on UJ, second is a buy on the SPX. The UJ is running in profit. The SPX is actually running in a loss. So not the best story, but again, ChatGPT managed to pass phase 1, managed to pass phase 2. So I'm not that worried. I think I will eventually be able to reach a payout. So yeah, if you want to get funded, DNA funded, great company ran by professionals, and one of the few companies that's actually legit, that's actually not going to scam you and not going to disappear in like 5 or 6 months. So let me see what you guys are saying before I go through my watch list for this week. Let's see. Hey Sluggy, welcome. Bring Kevin Hassett as the Fed chair. You know what's funny is if you go to the Fed chair Polymarket, oh, not this one. This one. So Kevin Hassett was actually leading. See, Hassett was leading by like 85% at one point. And then Trump came in and Trump said that he is considering either Hassett or Warsh. And now Warsh is leading. So now Warsh is leading by 45%. Hassett is 41%. There hasn't really been an impact of this in the markets. I'm not sure if Hassett is more dovish than Warsh. I'm not sure. Maybe Warsh is even more dovish. So I'm going to have to check that. But there has been a drastic change in the Polymarket who will Trump nominate as Fed chair voting system, you can say, or betting system. And yeah, this is a great website if you want to check how the odds are doing. And you can actually structure your trade ideas on this chart, because let's say that Warsh was super hawkish. I don't think he is, but let's say he was super hawkish and he won against Hassett. Well, the dollar could definitely gain value on the basis of that decision, because if there's a very hawkish Fed chair, the dollar usually goes up. So I thought that was an interesting development. Hello, Alan. Welcome to the stream. Talk about the USD CAD. Okay, I can do that for sure. How are you doing? I'm doing pretty well, Joshua. Thank you for asking. How are you doing? Hey, Marco, how do you see Euro Yen? Balance of trade, inflation rate, interest rate decision out later this week. Thank you. Okay, we can cover EJ. What a crazy trading year. It has been pretty crazy. The craziest asset, I would say, is silver and gold. Then you also have the S&P with Trump tariffs, with the massive drop. So definitely a special year. Trump, always fun. There's always a lot of fun with Trump. I re-entered, Sluggy says I re-entered GBP NZD shorts. I took partials on the last low. We can bring that up. Taco Marco, hello Bolat, welcome to the stream. Oatman, how's the dollar going when you called me crazy? I'm dollar short now. DXY to 95. Looking to short dollar against the CAD and the NZD. I'm long GBP USD. I'm working on a new campaign, DXY to 92. Damn, that's a pretty large bet. Trump already kind of admitted to insider trading by saying new Fed should confer with him on interest rates. Yeah, I think what actually happened is you had a statement from Hassett, from Kevin Hassett. He made a statement saying, I'm not going to be influenced by the White House on interest rates. Maybe Trump didn't like that statement. I don't know. But essentially, Trump came out and said that, you know, he's not so sure about Hassett. He's going to consider between Warsh and Hassett. So the probabilities dropped drastically. Pretty funny. It's all politics in the end. It's all politics behind closed doors. Kind of sad, actually. Okay, let's see. Palladium, platinum. I bought gold during London and I got stopped out. Do you use? Are you still looking for a position on euro dollar? Okay, so we can cover that. That's basically my watch list. Euro dollar, took a position on this one, but I think it's on Oanda actually. Yeah, took a position on the 2nd of December, closed it on the 11th of December for a nice profit. Price has continued going higher. I'm no longer that interested, if I'm being honest. I don't think the euro is that strong. I think the dollar may be, for 2026, may be more hawkish than people expect. So I'm not extremely bearish on the US dollar. For me personally, I'm not looking to re-enter this position. I'm looking at some other currency pairs. And my general view on the DXY, on the dollar index, yes, it's going lower. I don't think it hits 95. I think that's a big number, a very low number. I think something has to be fundamentally broken in the markets for the DXY to drop to 95. For example, tariffs, crazy Trump tweet, a new war starts, or something like that. But just the Fed being dovish, I don't think it can bring the DXY to 95. It's very expensive to short on the dollar. The big whales, the big players, they don't want to be short on the dollar because they're paying 3-point-something% every year to keep that position open. It's a negative position. So what I think is we could see a bit more downside, but I think we're not going to get as many rate cuts as people believe. So for 2026, we have 2 rate cuts priced in, 2 rate cuts of 25 basis points. But you have to look at the situation. We still are not sure who is going to be the head of the Fed. That's an uncertainty. Inflation is elevated. So if you go to inflation CPI, USD, inflation is above target. Inflation is 3%. And if you kind of keep your ear to the streets, you would notice that people in the US are starting to shift from wanting cheaper loans to possibly wanting inflation to go down. They want their purchasing power to stay protected, let's say. And of course, the Fed listens to the people. Politicians sometimes listen to the people because they want to get reelected, because they want to be popular. So they may be more hawkish than expected. And the Fed has announced just 1 rate cut in 2026, while the market is priced in for 2 rate cuts. So that's a clear difference. You know, the Fed says 1 rate cut, market prices in 2 rate cuts. I think that is hawkish. So that's the whole story. How does it translate into the price? I think I'm more bullish than other people. I think at 26, the DXY could start regaining some value. Okay. I know it's a pretty unpopular opinion right now. I think everyone is short. Of course, when everyone on the internet is short, it may be a good time to do the opposite. So that's also something to consider. NFP came out a bit mixed as far as I can tell from the numbers. Let's see if the Edge Finder has the update. Let's see. So labor, NFP. Okay, so how is this such a huge beat? While on my Forex Factory calendar, it's not such a big beat. So it looks like the data is a bit different. But anyway, looks like the job market is doing well. If this is the actual number, if we came out at 128K and the forecast was 50K, that's bloody amazing. So that's awesome. And I would say that also goes well with my story of being more hawkish than most people are, and being more bullish on the dollar right now. Again, I think a bit more downside can happen, but I don't want to place huge bets for DXY to go lower at this time. Definitely not. Looks like the jobs market is not so bad. Yes, the unemployment did go up. If we can see that, the unemployment rate, let's see. So the unemployment rate did go up to 4.6%, and that is exactly what we do have on Forex Factory as well. But you have to note, artificial intelligence, productivity goes up, unemployment rate goes up as well. People will get replaced by AI. That's the way things work. That is the reality. That's coming sooner or later. Okay, so let me see some more requests that we had a bit higher. EJ, let's see, EJ, top setups. I don't have a clear view on the Euro Yen. JPY. So bullish reading from the Edge Finder. I don't know. It all depends on the meeting on Thursday. All depends on the BOJ. If the BOJ skips the hike, we could see this go up. But if the BOJ actually hikes rates, there's gonna be a bearish move. There's gonna be a bearish move. Okay, it's a big thing. Hiking rates on the Japanese yen ruins the carry trade, makes people a bit uncertain, makes people buy the yen. Okay, it makes the yen go up. Just the reality. So I'm waiting for that Thursday decision. Maybe I'll buy USD yen just before it with small risk to test out the strategy that I was talking about, but I'm not so hot about it because the BOJ is so unpredictable. USD CAD, yes, that was the one. USD CAD. I'm actually starting to become a bit bullish on the CAD, maybe a little bit. Let's see the heat maps. Canada. Last number was the CPI. Came in lower than expected. But again, as far as Canada's economy goes, it's becoming better and better. The numbers are becoming healthier. The unemployment rate is going down, I believe. Yeah, see, the unemployment is going lower. I think their GDP is pretty good as well. I'm not looking to take a position. Again, I've switched to a bit bullish on the CAD, but on the dollar, I'm not bearish. I'm just not going to sell the dollar right now here, USD CAD. So not my favorite thing at this moment. And also Sluggy said, let's see. There was a comment from Sluggy, if I can find it. Was it GBP NZD? GBP NZD. Let's see that. GBP NZD. Now, the thing I like is NZD. GBP NZD. So I like GBP NZD because, or I like the New Zealand dollar because the RBNZ, Central Bank of New Zealand, has flipped from being dovish to hawkish. That's bullish. So I'm actually looking to buy NZD-USD. So let me quickly show you that. NZD-USD, if we can get some pullbacks, if we can get a cheaper price, a better level, I'll be looking to get in. I still like the New Zealand dollar very much. As far as GBP NZD goes, I'm not 100% certain. The pound has been gaining some value. The price actually looks flat, if I'm being honest. What does the Edge Finder top setup say? I usually like to follow the reading from the Edge Finder. Neutral reading as well. So yeah, neutral reading, technical analysis on the daily chart looks flat. Fundamentals, definitely bullish for the New Zealand dollar. For the UK, I'm not certain. I'm a bit neutral on the pound. But if I had to pick a direction, it would be too short. It would be to sell this. But again, not for me. Definitely not for me. I don't have enough confluences to execute that position. Let's see. Euro dollar sucks. Forex sucks these days. Forex has been pretty tough and slow in 25. That's just the reality. So in 25, the clear winner was gold and silver. Just look at these massive trends. SPX, NASDAQ, great assets as well. A lot of appreciation in 2025. But Forex has been rough. Forex has been tough. Crypto also has been tough a bit, especially nowadays since we went below 100K. It doesn't look good, but Forex has been problematic. Really low volatility, not a lot of movement. So better to focus on the metals market than the indices, if I'm being honest. But things will change. Just the way the markets work. Some years are great for Forex. Some years are great for metals. Some years are great for indices. Don't you think buying CAD is a better deal overall than USD? I think buying the CAD could be a good play. Yes, and I think it could be a better deal than buying the dollar. I would agree. So I'm not super bullish on the dollar, but I just don't follow the whole extremely bearish sentiment that I'm seeing online. And like Ballout says, DXY to 95. It's just not a view that I share. So I'm not like a full-on bull, but I'm definitely neutral on the USD. Definitely more neutral. CAD seems to be gaining strength, so that is why I think it's pretty interesting to buy the CAD. Yields are sticky. Let's see the yields quickly. 10-year going higher for sure. What about the 20-year? Damn, going higher as well. 30-year. Okay, definite problem for the US administration. They don't want to see sticky yields. They usually think if they cut interest rates that yields go down. Not the case. And also I saw somewhere that the US government is bragging that under Trump the bond yield is super high, meaning you get paid a lot. That's not a good thing. You don't want bond yields to be high. It reflects a lot of selling of bonds, right? So you want low yields. That's a better situation for the United States. It also makes the debt cheaper to repay. Trump would like lower rates. You can look at his social media. He definitely wants lower 10-year, 20-year, 30-year yields. But it's not going to happen with just cutting the federal funds rate. It doesn't work that way. It's a market like any other. So let's see, last comment for today, because I am approaching the end of my segment. Let me see if someone is behind me or after me, not behind me. Schedule. No. Okay. So last comment of the day. CAD Swiss. CAD Swiss it is. CAD Swiss. Let's see. CAD CHF. Starting to become a bit bullish here. What does the edge finder say? CAD CHF. Neutral reading. Now that's a problem. That's an issue. I think it's because in the heat maps, Canada is still bearish. But I would say the numbers long-term are improving. So long-term are improving. Short-term is not reflecting that. So if we can get the short-term data to point bullish on the CAD and CAD Swiss to become a bullish bias, then it's game on. As far as we are doing now, we have just broken out of this range, starting to become a bit bullish. So it's not for me. I don't see a definite edge in this currency, in this particular currency. Like for the NZD USD, I see a definite edge. It's bullish. It's on an uptrend. Edge finder, NZD USD was bullish. I think it still is. Yeah, bullish reading. I love the fundamental situation with the New Zealand dollar. So that's my top pick for now. That's it for me today. Thank you very much for watching. I will see you tomorrow. I'm streaming for the whole rest of the week. Good luck in the markets. And yeah, that's it. See you.
Thank you for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want to get put on the nice list this year? Then make sure you check out the A1 Stock Box. That's all for today, everyone. We'll see you tomorrow. Ho, 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 ho.